What if I told you that I can teach you a systematic approach that you can take every day into the markets and make hundreds of thousands of dollars of payouts? Well, this is exactly what I did with my trading. And I'm going to be teaching my simple system that I use every day to get funded and get over six-figure in payouts every single year. I'm going to be teaching you step by step exactly what to do in the markets. And step one is always understanding the market direction. This is really important, but a lot of traders struggle to do something so basic. Understand what is the overall direction of the market. You understanding that will be the difference between taking low quality setups versus high quality setups. It's very simple. Are you in a bullish trend like I'm showing here, or are you in a bearish trend? But what's difficult is how do we establish it? And this is where understanding order flow comes into place. Understanding order flow is quite simple. It is simply, are your bullish levels being respected? Are your bearish levels being disrespected? That will tell you that you're in a bullish order flow, which means the trend is bullish. So you can zoom out and look at price and look at your higher trend for value gaps. For example, if we are trading on a 1 hour fair value gap and we had a bullish one sitting right here, you can see that price perfectly respected the 0.5 and bounced off the fair value gap. While if we had a bearish one here and price has displaced through it and causing an inversion fair value gap, it's telling you that bearish levels are not being respected. And also we can look at is understanding the liquidity. When you take out a bearish high, do you continue the uptrend or are you reversing from it? If you continue this uptrend here, more than likely you're sitting in bullish order flow. And the opposite will apply if you're sitting in bearish order flow. This will help you understand where the directions of the market should be for the day, help you identify higher quality setups that follow the overall market directions, as well as understanding when to take profits. Now, step number 2, which is really important, is where is our key levels? You understand, once we establish a direction, we have to establish where are key levels that will put us in a trade. So what I'm looking for is to follow the direction, then wait for a retracement to key level or a push to a key level, and when the key level happens, waiting for a reaction. But how do we know which key levels to aim for? Well, these are going to be your most important key levels. Fair value gaps, and these are going to be higher time frames, anything from a 15-minute all the way to a 4-hour or a daily fair value gap. Then low liquidity, which is internal liquidity. This is simply during a trend or during an uptrend, as we make our way up, this recent lows becomes our low liquidity level. So this will be our low liquidity within this uptrend. Next, previous day high, previous day low, previous week high low, and previous month high and lows. These are really important levels that the market tends to respect. Understand that whenever you take out a previous day high, that could be a potential target if we're long here. For example, if we're long after this move that we took out internal liquidity and our previous day high was sitting up here, this could have been a level that we could look to take profit. As well, you can write in the previous day closing price. That's also a really important level. And lastly, pre-market highs and lows, or London, Asia high and lows. Those are going to be levels that we more than likely will look for somewhat of a direction off of. We'll look for them as a target. We'll look for them to potentially reverse off of. Really key levels that you do need to put into your price. It's very simple. With the previous day high and low, weekly high and lows, you simply need to zoom out here on your higher time frames, mark them out, and just wait for price to hit. And when they hit, then you start looking for a lower time frame entry. That's when we'll talk about the 5-minute, 2-minute, 1-minute time frames. Now, if you're looking to get help one-on-one and work with me directly, like I did with all the students I'm showing you, which have gotten $20 in payouts, another $20 in payouts, $3,400 last on his payout, all these students work with me one-on-one in a mentorship where I help you not only with your trading, but the hardest part about it as well, which is risk management, understanding how to scale up, understanding how to manage your emotions, how to deal with green days, red days, so on and so forth. Just make sure you click that first link down below to see if it's something that would make sense for you. Now we move on to step 3, which is low time frame entries and confluences. This is simply, yes, we understand what the overall range of the market is, if it's going higher, if it's going lower. We understand where our key levels are at. But now, how do we actually enter a trade? And it's because of this next step, which is zooming down to our low time frames and look for confluences that will confirm an entry based on a large time frame analysis. And you have to understand this. If you don't have a higher time frame analysis and a lower time frame entry model, you cannot take a trade. Now, the confluences I'm looking for are going to be an SMT, golden pocket retracement, a fair value gap, or an inversion fair value gap, and equal highs and equal lows as a bonuses. Now, what our requirements are going to be your first three. You will need to wait for an SMT. You will need to wait for an GP. You will need a fair value gap or an inversion fair value gap of some form. And lastly, equal highs and equal lows would be a bonus, which if they are there as a potential target, or if we just took them out and we are having a move out of them, tend to be a much higher quality setup. And on a higher quality setup, it means sizing up. Remember this, the higher the quality of the setup, the more confluences, the more confident you are on that trade, the more you can size up. Now, I'm not telling you to full port your whole accounts, but I am telling you to take bigger risks when the odds are in your favor. Now, let's jump into the charts and see how we would have analyzed this based on yesterday and the previous day's price action. First of all, we can see we were on a big downtrend off of this Thursday candle right here. Price had broken new all-time highs, and from the all-time highs, we had a big move down. Now, since we're going to the Friday price action, we would have marked out the previous day low, which would have been right here, as well as the previous day high, which also would have lined up with our all-time highest level. So you can mark this in and have them ready for you to take action off of them. Previous day high and previous day low. Now, this was our Asia session right here. As you can see, we went sideways all of Asia session after, guess what happened? Taking out the all-time highs. Now, we have to understand what is happening here. We just broke a new all-time high. We're also a previous day high, but we're failing to continue above them. This would raise a red flag for me, understanding what order flow is not very bullish going into this New York session. Now, it's not enough information for me to take a trade-off, but it is something that I can note. Then right around when New York session is gonna be starting, which is 8 a.m., at 6 a.m. we start selling off. We get a big move to the downside. As you can see right here, then we get a small retracement up, and then right at the New York open, which is around this 9:30, we get another big move down. So we're seeing all of the, if we zoom this out, we can, and let's zoom this out even further, we can see we had an hourly fair value gap here, and this got displaced, which was a bullish fair value gap. And then we had a bearish fair value gap right here, which was being respected, right? Especially at the 9:30 to 10 a.m. macro. We see we retested it, and then we respected it. This is really important because it's, again, telling us where is order flow heading towards. If we really take out the previous day high, then more than likely we're going to take down the previous day low, right? That's more than likely where price would want to head towards. If not, we would have displaced this 1 hour fair value gap. We were broken above the previous day high. We were broken above the all-time highs, and we would have kept pushing. Now, we're going to add ES as well to this chart so that we can look at both at the same time. We'll zoom out on the 1 hour on ES. As you can see, we can remove drawings here. And on top of that, we can see with a really big SMT here from the 6 a.m. high, you can see ES had broken above it while NQ did not. So these highs right here would have given us our SMT divergence. Again, if we go back up above, what do we need with SMT, a GP for value gap, inversion for value gap? We have a bearish for value gap that's being respected. We have an SMT. Do we also have a GP? So we will mark out the all-time high candle all the way down to the recent low. As you can see, this GP is being held up right here. This is exactly where we're getting our rejection. So this is where we jump into the 5-minute or below to look for an entry. Now, this is when we would zoom in to our smaller time frames, and essentially what we're looking for is a lot of the same stuff that we looked for the higher time frame, just zoomed in on the lower time frame. So we know that here would be our key level during the New York Open. 9:38 open up. We got a big move down. We're waiting for the GP retest for the whole move. We're waiting for confirmation. We're waiting for an SMT. We're waiting for all the above. We don't get our SMT again here. As you can see, this is where we get our SMT, right? Respecting the golden pocket, respecting the 1 hour, the large time frame, bearish fair value gap that we were watching on NQ. So what I would mark on this lower time frame, I'll clean up a little bit of the price here. I'm gonna raise this, raise some of these arrows, is I'm waiting for one or two things. I'm waiting for my first bullish gap to get disrespected. As you can see, this happens right here. our first 5-minute gap that gets respected because I'm waiting for the lower time frame order flow to get changed from bullish to bearish so I can enter confidently my bearish setups. 2, I'm waiting for an internal high to get taken. Internal high to get taken needs to be a bullish one, obviously, because we're trying to trade to the bearish side. Remember this quote: always short above highs, only long below lows. This is going to remind you to wait for some liquidity to get taken out to then enter. So as you can see, we had all of our highs were here. So this was a high, this was a high, this was a high right here. So our latest high would have been right here. So we took out the latest high, which would have been our manipulation above the high. Then we inversed the 5-minute bullish gaps. And then what we're waiting for is the 5-minute bearish gap to be created and be touched. So our first 5-minute bearish gap is right there. So you can see on this candle, it gets tapped into, and that would have given us an entry. You could have entered this trade just like this at the close of this candle with a stop loss above the fair value gap, targeting the latest lows, which in this case would have been all the way down here. Now, my runners and my extended TPs after seeing such a big move down would have been the previous day low. Keep in mind, more than likely that's what we wanted to target. More than likely that's where price wanted to go. But I'm using the opposite side, the buy side liquidity now, the buy side lows as areas to take some PTs. So you can see even here, although we did take it out, we did continue down, but you see you got a little move here, a move to retrace into this 5-minute gap. Again, respecting bearish order flow and continuing that trend down. Here, a lot of traders, after this low gets taken out, they would have looked for price to give a reversal. They start longing here. They start trying to take this trade back to above, but they're not doing all the other homework. They're looking at one simple thing, which is a low, getting a bounce, and they're taking a trade off of it. But the way you find high quality setups is doing all the things we just went over and waiting for all of them to line up before you're taking that trade. And as you can see here, you would have found this continuation trade as well to find it, to catch the second move to the downside. We also keep an eye on yes on the opposite end. We see, hey, we just took out this low right here and we're still getting continuation lower. More than likely we're going to go down to this next low, which is our liquidity where it's sitting, and then eventually all the way down to the previous low on yes as well. So this is exactly how you want to put everything together, manage your risk, and doing the high time frame to low time frame analysis to get payouts like I have. Now I'm the top 5 highest payouts of all time on one of the biggest firms out there, which is Alpha Futures. Now in our last slide, let's talk about how to manage risk. This is personally how I typically manage my risk. Now this will always be a little bit adjusted depending on the trade, depending on the quality of the setup. For example, sometimes I might have a 10-point, 15-point stop loss, but typically this is how I would manage it. I will risk 0.5% of an account, which is my prop firm account, with a typical stop loss between 20 to 30 points, which is a little bit aggressive. But the way I trade, it works really well. 3 trades max per day, and usually I would be looking for ROI of at least 1.5. Again, guys, you don't always need a huge risk reward trade. Having a decently high win rate, 60% plus, with at least a 1.5 R will be very, very profitable for you. This is how I manage it. And the way I scale up, I don't add more contracts. Like, Antonio, I think I'm ready to scale up. No, the way you scale up is you start copy trading more accounts. You can use softwares like TradeSyncer to connect multiple accounts with different platforms out there to make more money. And that's the way you want to scale up. You don't want to just start sizing in heavily just because you build a buffer. And one of my biggest rules is whenever I can request a payout, I'm going to be requesting my max payout that I possibly can. So there's nothing worse than unrealized payout losses. I recently had a student had $6,000 in payouts, and he tilted one day and he lost that $6,000 buffer, closed the account, and now he missed out on $6,000 that he could have requested. Imagine how many accounts you can buy if you take $6,000 and then you lose it after. There's no harm in that. So if you want to learn more directly from me, if you want to learn how I'm making these gains in the markets and how my students are doing the same, make sure you click that link down below, subscribe to the channel, and as always, I'll see you guys in the next video.